Hi, Dr. David Phelps from the Freedom Founders Mastermind community. Last week I did a very special webinar with my good friend John Groom, CPA, and Jeff Watson, an outstanding attorney from the Cleveland, Ohio area. We did this webinar on tax strategies and legacy planning. Why? Because that's such a big issue right now for everybody, particularly professional practice owners who are just getting hit right and left by higher taxes, and it's only going to get worse. We got so many great questions and feedback from the webinar that we're doing a special phone conference tonight at 8 p.m. Eastern, 7 p.m. Central to answer the questions that you all submitted. Now, one of the questions that came up last week, which I thought was a great question, is this. Why does Warren Buffett, one of the wealthiest men in the world, why does he pay less in tax rate, effective tax rate, than his secretary? Now, his secretary is well paid. I think her salary was like $60,000 a year. Well, Warren Buffett, he's worth billions of dollars. And the problem is fundamentally that most people take their wages or their income, trading time for dollars, in what we call ordinary income, OI, ordinary income. Now, ordinary income, the problem with that is it's highly taxed. It's the most highly taxed form of income that one can take today. But that's the way most people receive their income. You either work for somebody, or if you work for yourself, probably you have a corporate entity of some kind, and you pay yourself wages in form of a W-2, which is ordinary income. Now, if you're a professional practice owner or a small business owner, you can totally change how you take your income and therefore how much tax you pay. That's what Warren Buffett does. Warren Buffett pays himself about a $100,000 salary from his Berkshire Hathaway company every year. $100,000, probably all he needs for his lifestyle, right? He doesn't live a big lifestyle. He does what he does because he loves to do what he does. So he pays himself $100,000, gives a lot of money away to charity, doesn't pay a lot of money on that ordinary income tax, so he keeps that tax rate low. The rest of his money comes from capital gains and dividends. That's the key. You see, he's taken his earned income over the years and transferred it as much as he can to capital assets. Now, Warren's capital assets happen to be businesses. That's what he loves. He invests in businesses. I love real estate. The people I work with love real estate. Same concept. It's a capital asset. When you have capital assets, the profit and the income or dividends is taken out at a much lower tax rate. In fact, with real estate, you can defer paying tax on the profit or the gain indefinitely. It's voluntary. You can exchange. You don't even have to pay that tax. Now, with rents, which are the cash dividends from real estate, yes, you do pay tax, but realize that the income or the dividends or the rents can be greatly offset by expenses. Only take as much ordinary income as you absolutely have to have to pay for your lifestyle. Find as many ways, legitimate ways, to turn your income and your assets into capital assets. Take your income out that way. Build wealth in this sector and you'll pay much less tax. That's how Warren Buffett does it. Take a tip from one of the wealthiest men in the world. Do what Warren Buffett does. Now, this is not tax advice for you. This is just something for you to take back to your CPA, your tax advisor, and talk to them about if you're not using a strategy similar to this. Check us out on the call tonight. It's 8 p.m. Eastern, 7 p.m. Central. We're going to answer more questions just like this. This is the stuff you need to know, and you need to know now.